Hi, welcome to Late Night Stocks. This time we analyze a huge corporation, Amazon.com. The company had strong earnings and growth rate for more than 2 decades. We are going to compare the company with its American competitor Walmart and Chinese rival Alibaba. And then evaluate Q1 earnings, talk about Amazon Web Services, and finally make stock price predictions. Let's begin. Let me explain blue chips. First of all, we don't mean blue integrated circuits. The phrase is believed to have been adapted from poker game terminology. You probably know poker sets consist of different colors of chips, and every color has a different value. For example, a white chip might be worth $1, red $5, and blue $10. Blue chips could be considered as most valuable, therefore, the companies with high reputations such as Amazon, Apple, and Coca-Cola are named blue chips. Some of those companies also known as dividend aristocrats with a long history of increasing dividend payments year over year. Amazon prefers to reinvest its earnings and didn't pay dividends. Amazon.com was founded by Jeff Bezos in the mid-1990s in order to get part of the internet boom, or namely dot-com bubble. He wanted to be biggest online bookstore like Amazon River on the planet. One remarkable report about the future of the internet that projected annual web commerce growth at 2,300% has affected him, and Jeff Bezos prepared a list of plenty products which can be easily sold online. He started with selling books. Due to the large worldwide demand for literature, the low unit price for books, and the huge number of titles available in print. And now you see Amazon's first gateway page. Walmart is a US-American multinational retail corporation which is based and operated in Arkansas. The company runs a chain of hypermarkets, discount department stores, and grocery stores. According to the Fortune Global 500 list, Walmart is world's largest company by revenue with $559.2 billion. Between the fiscal year 2014 and 19, the compound annual growth rate of Walmart's retail revenue was 1.5%. Meanwhile, the same rate for the Amazon.com during that period stood at 17.7%. Let's talk about another competitor, Alibaba. The Alibaba Group was founded in 1919 by 17 people and Jack Ma, a former English teacher from Hangzhou, China. It's hard to say. He wanted to take part of e-commerce boom. The company has targeted B2B or business-to-business market in China and wanted to be the middleman between them. They also became successful globally and started to provide also C2C, B2C, and B2B sales services via web portals as well as electronic payment services, shopping search engines, and cloud computing services. I'm not going to compare Amazon and Alibaba in depth, but let's say Alibaba is not quite Amazon yet. Amazon had 4 times more total revenue, namely $296 billion in the 12 months end March 2020. On the cloud revenue side, Amazon revenue was $37.5 billion, which was much higher than its competitor. Operating profits were similar because Alibaba had more profit margin. Please leave your comment below if you want to watch a more detailed video about Amazon and Alibaba. Let's evaluate the Q1 earnings. Amazon has beat the consensus estimate by wide margin. Earnings per share were $15.79, that is about 65% more than analysts' projections. Amazon's total revenue was $108.5 billion, coming in 3.8% higher than analysts' prediction. Amazon Web Services revenue for the quarter was $13.5 billion, which is 3.1% higher than consensus estimate. Amazon Web Services plays an important role for the company. E-commerce can be volatile and has much lower profit margin. Amazon Web Services profit margin in Q1 2021 was about 30%. Amazon's two e-commerce based segments had a combined operating profit of less than 5%. As a result, each incremental dollar of Amazon Web Services revenue raises total profits much more than an additional dollar of e-commerce revenue. Let's have a look at the cloud business. Amazon Web Services got the 32% of the cloud market in 2020. In other words, the lion's share. Microsoft Azure and Google Cloud followed it with 20% and 9% by revenues. Let's talk about the 24-year Amazon veteran and the next CEO of Amazon, Andy Jassy. He started at Amazon in 1997, just before the IPO. He helped to launch Amazon Web Services in 2006 and made it the cloud market leader. He is also known Jeff Bezos' shadow and will succeed him as Amazon's CEO in the third quarter. The future of Amazon will be bright with Andy Jassy. By the way, Jeff Bezos sells his Amazon shares to fund Blue Origin aerospace company. He sold about 2.5 billion of Amazon stock this year and more than 10 billion last year. He will probably continue to sell until the end of the year. It may affect the stock price in the short term, but the investors can take advantage of the discounted prices. Although the company had strong earnings during the past years, the Amazon stock price has been steady since last year. As we see from the stock market, there are two types of corrections. Either a stock rises fast and falls sharply, or it rises and stays at high levels for a long period without reacting as strong earnings or positive news. We can probably see a massive jump in upcoming months. When we look at the chart, during the past 13 years, Amazon's highest PE ratio was 3,732. The lowest was 45 and the median was 144. As of today, 20th May 2021, Amazon's share price is $3,231 and corresponding PE ratio is 61. The forward PE ratio is expected to be slightly less than 45, which was the lowest PE ratio during the past 13 years if the stock price stays the same. As we see from the stock price history chart, the stock price is close to 200-day moving average. It may also be an important criteria to evaluate fair price. If the stock price will follow the trailing PE ratio, which was 61, it should hit to $4,400 in next year. I think in bullish case, up to $5,000 in next year can also be possible. Let's have a look at our chart. Amazon is a great profitable company. The CEO Jeff Bezos is a brilliant manager. Cloud business is disruptive and the demand is going to be huge in the future. Despite the market cap, the company is growing rapidly. When we look at the historical PE ratios, the company seems undervalued, which can be an opportunity for investors. Please also do your own research before you invest. Thanks for watching. Please give a like and don't forget to subscribe.